Hello everyone, and welcome to the Financial Prophet. Today we're going to discuss the week ahead. So there's been some controversy recently regarding Fed Chair Powell and whether the Trump administration is actually building up a case to fire the Trump-appointed Federal Reserve Chairman. However, the Fed is an independent agency, and despite Fed chairs being appointed by presidents, there really is no legal precedent to replace a Federal Reserve chair without due cause. Still, there are whispers of a shadow Fed chair, and inefficiency or the mismanagement of the Fed's mind-blowing $2.5 billion renovation project may provide some ammunition necessary to actually replace Chairman Powell. Now, let's discuss high interest rates and how they're hampering economic growth. I'm not a proponent of high interest rate policy, especially with mortgage and other long-term rates at these levels. Right now, we're witnessing the highest mortgage rates in decades, and credit card rates have never been this high. Look at this chart of mortgage rates. This is the weekly average level for the 30-year mortgage, which is around 7% now, and as we can see, it is around multi-decade highs here. We haven't seen such extremely high levels since the late 1990s, actually. Moreover, treasuries are also trading around decade highs. This dynamic especially applies to the long end of the curve, and with the 30-year around 5% is the primary reason why mortgage rates are ultra high here. So here's the chart of the 30-year treasury, and we see that the treasury as well as mortgage rates are around multi-decade highs. Mortgages even more so, probably because there's a bit more risk in the system now with all the debt in the system now. So my question is, does the Fed want to trigger another housing type financial crisis, the likes of which we haven't observed since 2008? Because with mortgage rates basically skyrocketing to nearly 7%, many areas of the housing market are showing signs of considerable cooling and even strain. We're seeing year-over-year house prices decline in key cities in Texas and in many other areas in the U.S. In fact, recent data shows only about a 1.6% year-over-year nationwide growth versus 6.2% last year. So this dynamic that's causing housing prices to decline is quite negative because it could even lead to deflation in the near term possibly. Now let's look at the national debt, as it is another very significant issue. So the national debt is absolutely massive. The United States national debt is at a staggering 37 trillion, 123% of GDP. And most of that debt is made up of 5, 10, and 30-year treasuries. Now, the interest payment on the national debt alone has ballooned to roughly $1 trillion annually, and it would be highly favorable for America if the Fed lowered interest rates. With lower interest rates, the U.S. could potentially refinance a chunk of the monstrous federal debt. Moreover, the U.S. government could issue new long-term treasuries at considerably lower rates. It's even possible to introduce 40, 50, and potentially even a 100-year treasury in the future to control and reduce interest rate payments on the national debt. So now there are some big downsides to high rates. Unfortunately, with interest rates being where they are now, relatively high, and considering the enormous ever-expanding debt loads, we cannot do many of the positive things necessary for the economy to move forward full steam ahead. This is, again, very unfortunate because the U.S.'s dynamic economy could go through a remarkable golden age, in my view, if allowed to fire on all cylinders. I believe the market is beginning to recognize this bullish, intermediate, and longer-term dynamic of a more accommodative monetary policy. Therefore, while the Fed chair may not get, quote, fired for the management or the mismanagement of the $2.5 billion renovation project, which, by the way, was supposed to be $1.9 billion, and still that's just a ridiculous sum to renovate any building, even if it is the iconic Federal Reserve building. So regardless of his management or mismanagement of the funds, his term will end on May 15, 2026, which is in fewer than 10 months. Now, there's also mounting pressure from the White House and other critics, and there have been more calls for easier interest rate policy from more and more market participants recently, as well as from even members of the Fed. Therefore, we may see more pivoting toward a more accessible monetary stance moving forward, which is a constructive dynamic for stocks and risk assets in general. So earnings season is upon us again. Last earnings season was, of course, a little bit challenging as it roughly coincided with the April, quote, Liberation Day crash. Earnings season is heating up now, nonetheless, with several crucial companies reporting. Now, we witnessed mostly solid reports from the banks last week, and this week we will also witness earnings from more bellwether companies, like Verizon, Coca-Cola, Alphabet, Tesla, and others will report this week. And I believe we could continue seeing better than expected results. Also, in addition to the earnings, we have some crucial economic readings this week. So Fed Chair Powell speaks on Tuesday, and this should be very interesting given the recent controversy and current market dynamic. We will also see key homes, building, oil, durable goods, and other data points this week. Now, while there are no essential inflation readings this week, we will receive the highly anticipated core PCE inflation number next week. So what is the Fed doing now, given all these moving parts? Well, what the Fed is clearly not doing is that it's probably not cutting rates this month. However, there is about a 63% probability that the Fed will reduce interest rates in September, which is relatively high. Now, while this percentage is not exactly 100%, it's actually far from it, it does demonstrate that there is a relatively high probability that the Fed will cut rates in September. Also, if the Fed doesn't cut in September, it would be a negative surprise for markets, and we could witness a considerable pullback, sell-off, or even a correction around this time. So the bottom line here is that, the rebound off the April bottom has been absolutely spectacular. In fact, it's been one of the most robust stock market recoveries in history. The S&P 500 has surged by over 30% since the April 7th lows, and it looks like it could continue to run to about maybe even 6,500 in the near term. Despite being considerably overbought, the momentum remains pretty solid here, and it may push the S&P 500 up even higher before a potential August-September pullback occurs. Of course, we want to be very mindful of the 6350 resistance level on the upside, as well as the 3 to 6250 initial support zone on the downside. Moreover, 62 to 6180 support, if it breaks down, the S&P could pull back to approximately the 6,000 level. This would likely create a very lucrative buying opportunity, as this consolidation pullback process could pull the S&P 500 towards the 6,000 range, which should attract a lot of buyers to come in and probably buy the market at that level. Now, despite the likelihood for mild near-term volatility, I remain bullish in the intermediate and longer term, and I'm keeping my year-end S&P 500 target at 7,000. I want to thank you very much for watching my profit report. I truly hope that you enjoyed it, and more importantly, I hope that the knowledge you gain here helps you make more informed investment decisions in the future. I would also greatly appreciate hearing your comments, so please join the conversation in the comments section below. If you enjoyed my video, please click like, share, and subscribe to my channel so I can continue creating these highly informative and potentially very profitable videos. You can also join the Financial Profit, my exclusive investment community, which is Seeking Alpha's #1 service for proven portfolio profits. So don't hesitate to join our incredible investment community now. Thank you very much for watching. See you next time and have a great day.